Has anything changed in the silver market? There's too much silver moving around from left to right. Everything's booked up. Or is it because the silver literally isn't there in New York to be delivered? And why isn't it there? Because we'll need to keep it in New York because they're worrying that the maturing contracts will be called for delivery. So they can't send out silver that they might need when the contracts mature. It's easy enough for a large bullion bank to sell their silver into the market where they could get the highest price. You're trying to make a decision, do I deliver it to Shanghai or do I deliver it to COMEX? Well, you send it to where you get the highest price. For some reason, that's not happening. The difference in price has risen. At one point, it was over $21 difference. I think it's about $9 today. We can see that the number of open contracts on COMEX is many multiples, in fact, higher than the eligible, than the registered silver. The registered silver is what can be delivered. It's also higher than the combination of eligible and registered combined. We're seeing a large increase in calls for delivery. A large percentage of those futures contracts, instead of being rolled over or closed out, are actually called for delivery. We don't know because we don't know who's behind it. First of all, butt in about silver. Has anything changed in the silver market? No. The fundamentals of the silver market haven't changed. Everything is the same as it was before. We've still got all these geopolitical concerns. We've still got the supply and demand situation where the consumers, the industries which you need silver for manufacturing, they're not going to make less cars or less solar panels or less electronics because the price is lower or higher. It doesn't make any difference. Either way, it makes no difference. That's not changed. The fact that silver's become a strategic metal last year in America hasn't changed. The fact that China has decided to impose export restrictions from the 1st of January on silver hasn't changed. So absolutely nothing has changed. So if this was a stock, I would be saying the fundamentals haven't changed. I can buy more.
Yeah.
And thank God for the lower price, I'd be saying. Because I've still got, if I've only bought 33%, I've still got 66% left to invest. But let me just move on a little bit about the, this is more portfolio general as opposed to silver specific. In a portfolio general, it's nice to look at a portfolio full of winners.
The market wants you to believe price action equals reality. But this part quietly exposes how little has actually changed beneath the surface. As Clive Thompson frames it, industrial demand doesn't bend to short-term price swings, and that matters when over 50% of silver demand comes from manufacturing. Strategic designation in the US and China's export restrictions aren't sentiment-driven events. They're policy shifts with long timelines. When fundamentals stay fixed and prices fall, that gap is where long-term investors usually win. Most portfolios fail because they react to volatility instead of positioning for inevitability. What Clive Thompson hints at next reframes patience as a strategic edge, not passive hope.
You don't feel so bad if you have the odd loser in a portfolio which is full of green ink. But if you have a portfolio full of red ink, it can be psychologically distressing, not only to the individual concerned, but also embarrassing when you're talking to your family about how well you're doing as an investor. You don't want to be saying, look at my portfolio, and then you show them that she says, oh, that's a loss, that's a loss, that's a loss, that's a loss. And don't forget, you probably have an accountant in some cases, you probably have a banker, you probably have friends, you talk about stocks. You know, isn't it much more fun when you're showing your friends to show them, look at all my winners than all my losers? So the brilliance of getting rid of your losers, if indeed it's justified because you made a mistake and their fundamentals deteriorated, is you're leaving behind your winners. So you have a portfolio with much more green ink than red ink. And on the winner's side, price alone shouldn't tell you when to sell. It should be to do with position sizing. So
this is less about markets and more about human behavior quietly sabotaging returns. Clive Thompson is pointing at a truth most investors avoid. Psychological stress causes worse decisions than bad analysis. Studies from Delbar show the average investor underperforms the market by over 5% annually, largely due to emotional timing. Cutting losers isn't about ego. It's about stopping capital from bleeding into broken fundamentals. Meanwhile, selling winners too early often destroys compounding, which historically drives most long-term gains. portfolio health is visual, emotional, and mathematical all at once. What Clive Thompson explains next challenges the instinct to take profits at exactly the wrong time.
If the size of a position, because it's profitable, becomes so large that it's unwieldy in the portfolio, that's not a reason to sell it. That's a reason to say, should I adjust the size of my position downwards so it no longer has such a big influence on the performance of my portfolio? But for God's sake, don't sell it all, no matter how you feel. Even if you think it's a bad investment now, you should keep some of it because you've got that green ink, and that green ink is going to look great in your portfolio.
Yeah, totally agreed. Clive, final question. With COMEX delivery issues and potential shutdowns, how broken is the paper-to-physical system right now?
We've got a situation which may come up in March where we can see that the number of open contracts on COMEX is considerably, is many multiples, in fact, higher than the eligible, than the registered silver. The registered silver is what can be delivered. It's also higher than the combination of eligible and registered combined. Eligible is what's not, which is the right shape and size in the right place, but hasn't yet been allocated for delivery. But so all the COMEX silver in storage is not sufficient to meet all the contracts which are outstanding.
Here's where portfolio theory collides with market structure risk. Clive Thompson highlights position sizing discipline, then immediately pivots to a system-level imbalance most investors never track. COMEX data shows open interest often exceeds deliverable supply by multiples, sometimes 5x or more, which works only as long as contracts are rolled, not demanded. That's not a free market, that's confidence-based leverage. Keeping exposure while trimming size is risk management, not indecision. When paper claims outnumber physical metal, price discovery becomes fragile. What Clive Thompson warns about next exposes why March matters far more than daily price charts.
The number of contracts which are outstanding have been rising for the March delivery. And that's just 1 month, okay? It's not talking about February or April and so forth, but March is the big one. March is really, really big, which is why I'm talking about March. Now, it could well happen, and probably will happen, that before we get to March, many of those people who are long or short will close, each side will close their positions, and then there will be no problem in the delivery of the silver. However, I have observed that every month of 2025, the amount of silver being called for delivery was many multiples of what was called for delivery the year before, 2024. And in January 26, the amount of silver called for delivery in maturing COMEX contracts was double the year sorry, not double, I think three and a half times what it was the year before, 2025, which was 2.5 times the year before that. So we're talking about 7 times as much silver was called for delivery. The person who bought the futures actually want it, as opposed to rolling their contracts forward, as 2 years ago, as 2024.
This point quietly dismantles the illusion that delivery stress is business as usual. Clive Thompson points out a year-over-year surge where delivery requests jumped up to 7 times compared to 2024. That's not normal market behavior. Historically, most futures are rolled, not claimed, because physical supply can't support mass delivery. When buyers suddenly want metal, it signals distrust in paper settlement. March concentrates that risk into a single window, making failure harder to mask. This isn't panic, it's pattern recognition. What Clive Thompson says next connects this delivery pressure to broader systemic confidence.
So we're seeing a large increase in calls for delivery. And that means that when we get to March, it may well be that a large percentage of those futures contracts, instead of being rolled over or closed out, are actually called for delivery. We don't know, because we don't know who's behind it. Anyone could be behind it. Could be multiple parties or one major party. I think it's multiple parties. But if they're all calling for delivery, the silver just isn't there.
Yeah. Uh, I'm not sure that an average person on the streets understands COMEX, LBMA, Shanghai. So would you agree? Okay, let's stop on Shanghai. That's my final question. Does Shanghai reflects the real situation on the silver market or not? Is it manipulated? Is it similar to COMEX? How do you view the Shanghai?
Up until mid-December or something like that, early December, or maybe November, the Shanghai price and the COMEX price were pretty much the same. You'd have something between $0.25, half a dollar, and $1.50 difference.
This is where the paper market stops feeling abstract and starts looking fragile. As Clive Thompson points out, rising delivery calls aren't just noise. They test whether futures are backed by real metal at all. Historically, over 90% of silver contracts are rolled, not delivered, so a sudden shift toward physical demand is a stress signal. If multiple parties demand metal simultaneously, price becomes secondary to availability. The public debates charts while plumbing matters more. What he hints at next exposes why global price alignment quietly broke down.
And the reason they were the same was that it was easy enough for a large bullion bank to sell their silver into the market where they could get the highest price. Okay, Shanghai, the price is in renminbi or yuan per kilo, whereas in COMEX it's in dollars, but you can still adjust for the currency difference. So if you are a large silver producer or a bullion bank, and you've got some silver which needs to be delivered, you're trying to make a decision: do I deliver it to Shanghai or do I deliver it to COMEX? Well, it's pretty obvious where you send it. You send it to where you get the highest price. For some reason, that's not happening now. The difference in price has risen. At one point, it was over $21 difference. I think it's about $9 today.
Exactly.
But the difference is certainly not the sort of dollar difference you'd expect. It doesn't cost $1 to put a kilo of silver on a plane if you're talking loading up with hundreds of kilos.
Price spreads tell stories, charts don't, and this one is unusually loud. Clive Thompson highlights a $21 Shanghai premium that defies normal arbitrage logic, even after adjusting for currency. Transport costs can't explain it, which implies friction elsewhere: supply access, inventory risk, or delivery confidence. In efficient markets, gaps close quickly. Here, they persist. That suggests metal isn't moving freely despite higher prices. What he suggests next reframes this as a supply constraint, not a pricing anomaly.
So the question I've got, and I don't think anyone's really got an answer, but lots of people are supposing they know the answer, is it because the transportation system has just seized up? There's too much silver moving around from left to right and everything's booked up? Or is it because the silver literally isn't there in New York to be delivered? And why isn't it there? Because people need to keep it in New York because they're worrying that these maturing contracts will be called for delivery. So they can't send out silver that they might need when the contracts mature. Could be one of the two. Now, I'm rather inclined to believe it's a bit of both.
This isn't speculation. It's a risk assessment most investors never run. As Clive Thompson explains, logistics stress and inventory hoarding often appear together late in commodity cycles. When holders refuse to ship metal, it signals uncertainty about future obligations, not shipping delays. That behavior historically precedes tighter spreads and volatility, not calm resolution. For investors, this matters because paper prices can stay suppressed even as physical risk rises. What he leans toward next explains why shortages don't announce themselves loudly.
Clive, drawing from your statistical review of every major 5% plus crash in gold and silver over 140 years, what patterns emerge? In 2/3 of cases where silver rebounded positively the following year, with an average, let's say, 38% return, I believe, what conditions were similar to today?
I think it's more a question, not what was similar today, it's more what happens in a crash. And there I was studying stock market crashes, gold and silver market crashes, which had happened. And to get a statistically meaningful sample, I had to use crashes of 5% or more. And there were, across gold, silver, and the stock market, there were many, many crashes, hundreds of them, of 5% or more on a single day. So the question really is, what does a crash mean? First of all, let's talk about what happened after a crash. In general, and when I say in general, it was about 2 out of 3 times markets that had crashed by 5% were significantly higher a year later. And mostly a week later and a month later. Not always, but generally they were much higher. Of course, there was a 1 in 3 chance that they'd be lower a year later.
Crash statistics are uncomfortable because they contradict instinct. As Clive Thompson notes, 2/3 of 5% plus crashes led to higher prices a year later, with silver averaging roughly 38% rebounds. That doesn't make crashes safe, it makes panic expensive. Investors tend to sell at the point where probability quietly shifts in their favor. History doesn't promise outcomes, but it does expose behavioral patterns. What Clive explains next shows why volatility often plants the seeds of recovery.
But when they were higher, on the occasions when they're higher, in general, they were significantly higher, particularly for silver, much less so for gold, which seems to be a much more stable asset. But then there were far less 5% crashes for gold than there were for silver. I think silver had something like 8 or 9 times as many 5% crashes as gold did. So silver is a far more volatile asset. So when it's going down, it goes down further. When it's going up, it goes up further. So as you said, on the occasions when it went up, the 2 out of 3, it was up like 38% a year after the crash, whereas gold was a much smaller percentage up. I think it was something like 8 or 10% up after a crash a year later. I haven't got the figure in my head because it's not in front of me at the moment. Stock markets also displayed strong upwards movements in the years when they went up, and that again came to this sort of 2 out of 3 ratio. These figures are fairly approximate, okay, because there were variations, but broadly speaking, I think we can take it as a 66% chance that we'll be higher in a year, no matter what it is which has just crashed.
Silver's real risk isn't the crash itself, it's mistaking volatility for weakness when the math says otherwise. As Clive Thompson's long-run crash studies show, silver doesn't behave like gold because it isn't priced as a stability asset. It's priced as a liquidity pressure valve, which explains why it sees 8 to 9 times more 5% crashes, yet averages roughly 38% gains a year later. Gold's 8 to 10% post-crash recoveries reflect capital preservation, not explosive upside. This matters for portfolios because volatility compresses positioning, weak hands exit, leverage resets, and upside torque increases. Historically, that 66% recovery rate isn't optimism. It's structural behavior across markets. What he highlights next reframes volatility as a signal, not a warning.
What's the reason why that happens? Because as a general rule, when a crash is happening, there's a degree of two things going on. One, there's some panic selling. Those who are saying, I got it wrong, I'm out of here before I lose any more money, I don't care how much, I'm just out. And then the second thing is the people who are forced out by the market, because they're on margin, they have no choice, the stop losses are being triggered, and they're selling when they never wanted to sell. If they knew this was going to happen, if they would have had time, they'd have pulled their stop loss and lowered it or done something else. So those two groups of people selling basically mean we've got what's called at the bottom of a crash, you always have what's called an oversold market. More people have sold than really wanted to or intended to. The market has fallen further than it should have done, as justified by everything which is going on. And that's why when you get a recovery on the 2 out of 3 occasions, it tends to be a much stronger recovery than the fall itself. Because in general, and this certainly applies to the silver market this time,
most crashes aren't about new information, they're about forced decisions colliding at the same time. As Clive Thompson explains, roughly 2/3 of post-crash rebounds are amplified because margin liquidations and stop-loss cascades push prices below fundamental value, creating statistically oversold conditions. That selling isn't strategic, it's mechanical, which is why recoveries often exceed the size of the initial drop. In silver especially, leverage magnifies this effect, flushing out speculative positioning while leaving underlying demand intact. For investors, the risk isn't volatility, it's being structurally forced out at the exact point probability starts to favor recovery. His next insight explains why these rebounds punish impatience more than bad analysis.
The normal fundamentals which were applicable to the silver market, supply, demand, geopolitics, the debasement story, front-running what's coming with the government debt, all these stories are still out there. They haven't gone away. Nothing's changed. All that's changed was the psychology of the market in the blink of an eye. So probably if those underlying factors of supply and demand don't change, probably, and again it comes down, I want to say it's not an investment regulation, but 2 out of 3 chance we'll still move higher over the course of the next year.
Clive, in your February 1st video on gold miners, you asked if they were crashed too far, with gold at 6-day low and miners down even more. Now they are recovering, okay? Do the fundamentals of mining companies now make them more undervalued margins, or should investors wait for clearer signs of stabilization?
In both cases, if we go back to the start of the year, but this is also applicable now, start of 2026, all these mining companies, the last reported profits we have are the profits to the 30th of September 2025. And that encompassed a period from June to September, when the silver price and the gold price was considerably lower than we saw in the last quarter of 2025.
Nothing fundamental broke, only sentiment did, and markets consistently confuse the two. As Clive Thompson notes, supply constraints, geopolitical risk, and currency debasement didn't reverse overnight. What flipped was psychology, which historically resets faster than fundamentals. Mining equities sold off using earnings data locked to September 2025 prices, even though metal prices surged into Q4, a classic valuation lag Wall Street rarely emphasizes. That disconnect matters because miners are still being priced on margins that no longer exist. For long-term investors, this creates a timing asymmetry where fair prices in outdated data while forward earnings quietly improve. His next point reveals where valuation compression quietly turns into opportunity.
So the quarter which hasn't been reported, September to December, generally saw much higher prices, much higher than the quarter which has been reported of June to September. And if the present prices of gold and silver hold, the precious metal prices in the first quarter of 2026 will be higher, much higher, than the average prices in the last quarter of 2025. Now, we don't know whether the silver prices will go up or down or hold, but you can't do anything other than assume that they'll stay where they are until the end of the quarter, which won't be the case. But if they hold, we're going to have 2 consecutive quarters, the December quarter and the March quarter, at least, where the average selling price of these mining companies' precious metals will have been much higher than it was in the previously reported quarter. What that means is that in the next results, the December results will be reported in mostly a little bit in January, but mostly February, March, maybe some April, will be much higher for most. And then the following lot, which will be reported in July, August, September, will be much higher than the first quarter. I.e., you report the first quarter results, which the quarter finishes in March, you'll be reporting in May. So
the market is still valuing miners on quarters that no longer reflect reality. As Clive Thompson emphasizes, earnings lag pricing by design, and 2 consecutive quarters of higher realized metal prices fundamentally alter margin assumptions heading into February-May 2026 reporting. If prices merely hold, not rise, miners post stronger cash flows than anything seen in mid-2025, yet multiples haven't adjusted. This creates a delayed repricing window most retail investors miss because headlines focus on spot prices, not reporting cycles. The risk isn't buying too early. It's waiting until improved margins are already priced in.